following is a presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-445-1044.
Let's go to Sean in Canada. Hey, Sean, what's going on?
Hey, Tom. How's it going, brother?
It's going great, man. How you doing?
I'm a huge fan of the show. I just found out about you guys within the last month and a half.
Okay.
And I can't believe, I'm like, where did these guys come from?
How did you find out about us?
Sometimes I'll go in the search engine and try to find some market analysis.
Okay, man. Welcome to the Tiger family. Appreciate you growling and prowling with us, man.
Yeah, man. I really appreciate you guys, and I'm just excited to watch your bid. I get a lot out of them. I really love the intros you do and the excitement and the energy, and you guys are pretty special.
Well, we got a great network, man, and there's a lot of diversity, man, and we're really lucky. Thank you so much for calling, man.
Thanks, buddy.
Thanks, Sean. Have a great one. Have a safe one.
You too, bud.
Now, Tom O'Brien.
Hi, guys. Welcome to the Tom O'Brien Show. Tom's off today. I think he's down in sunny Costa Rica. In fact, I'm John Logan filling in. And I do a show every morning called the Global Market Pulse. I'm about 40% more awake in the afternoon. But that goes on from 8 to 9 every morning. So feel free to join me in the morning. We'll try to get a market kind of roundup before everything gets started, before the stock markets open at 9:30. We try to cover a lot of the usual suspects and do a little bit of stock picking and show some anomalies going on. Hopefully you can take advantage of on a day-to-day basis. This hour we're going to have a guest on, Steve Banger. We're going to have him on after the first break, and we're going to be treated to have Andy Hecht on in the second hour today. So stick around. Hope you guys can stay for the full 2 hours today. Well, folks, it's all about the 10-year. Let's pull it up here. And, this has been one of my favorite trades lately, along with the utilities. There's been really no backing off. I mean, the market, the Brexit situation happened as of, the most recent reason for the treasuries to rally. And that day that we're pointing out, the June 24th Brexit event day, that, again, that happened and made new highs. And now we've got new lows in yields. The 30-year is going nuts again. And the good news is, for a trade like this, you keep turning the rents the same way until the spine is broken of the trade. No matter how nonsensical it may be, you've got a couple of different things in your favor, though, in a large way on this particular type of trade to be long the treasuries still. You've got that arbitrageable situation on globally. You've also got the I'll raise my hand and want to be bought kind of factor. Every time the market has been rallying lately, the 10-year's kind of been going sideways at worst. So, market comes back a little bit like we've had today. And again, I wouldn't look at this as an all-out assault on the U.S. stock market. We're basically off all-time highs, just a smidget here. But when the market pulls back, the 10-year's catching a bid again. So, it's been a trade we've been talking about on my show for a long time. And the utilities, that thirst for yield, I want to bring this one up too. The XLU. Guys who are watching this show now, probably that old God Logan's going to talk about the utilities again. But again, you want to try to keep turning the rents the same way, take advantage of a good situation. And when you've got that 10-year sitting on the bid all the time and ready to do another launching pad move if the market comes off at all, you've got to be looking at that relationship with the XLU and that thirst for yield situation. As we look at a situation like this, when do you know when to call it quits and start rotating out of the sector? I think the 10-year really is going to tell you when, the worm is turned on this. But, I mean, the 10-year is in such a, never land of rates right now. Even if we get a pullback on the 10-year and the rates spike up just a tad, which I don't know if that's even got a possibility of happening anytime soon. The XLU could just consolidate up here, form a new profile, a new balanced area, and kind of spin around up here in a trading range at worst. So a lot of folks, I've been watching a lot of the talking heads on some of the news channels. They were talking about rotating out of this sector God, 15 percentage points ago. And, that was because we started having some breakdowns and we started looking at the 10-year and the Yellen knew, we're going to change the world with a quarter-point rate hike. It just really hasn't backed off. So, when you have something like that in a situation like that and you have the 10-year sitting on the launching pad, you've just got to continue to buy this sector. And a lot of guys, a lot of people don't look at it this way, but, this is the hedge. This is the go-to notes and bonds going through the roof type, hang on for dear life type sector. And you really don't want to ever dismantle the hedge if you're trying to manage a portfolio and you're trying to be somewhat safe. This is I'll call it a hedge. This is the type of instrument you want to keep on, or the type of sector. As I show this, we've got a great tool that I developed that we talk about in the morning, most mornings. It's called the TAS Profile Scanner. And you can go in here and look at this XLU sector, for example, pull it up, find the opportunities you need, and look at this. I mean, this is a sea of green. You've got a couple of things that are not exactly cooperating as well on some lower time frames, but when you look at this, if you guys are in your cars, you're not seeing this, but this is a matrix of green cells, and tells you where you can find some pretty decent high probability battle points to get in these trades, and definitely tells you when you can start looking at it from the other direction or scaling out some existing long trades. Somebody in the den saying this is a map of Ireland. It really is amazing how strong this sector has continued to stay. And I hope you guys don't, out there in your cars, rush home to take a look at the archives of this, because that's a pretty good product that I use on a day-to-day basis that I hope you can get some use out of. It keeps me out of trouble and allows me to block out one side of the marketplace, the long or the short side. Let's take a look at crude oil. Again, we're going to have Steve Banger on the next sector. Crude took it on the nose today. And as we look at this, we talked about this morning, crude's in a long-term balance area with that support at 45.66. I'm still going to stand by that. If we get a weekly close below there, crude, kind of the worm may be turning a little bit. But as you look at this on a daily, we talked this morning about, you might want to pass on this right now and just kind of wait for things to stabilize. There's not a lot of direction in this trade right now, even though we had a huge pullback today. $2.50, I think we ended up pulling back total. You're still within a long-term balanced area. And what does that mean? That means that the bottom of that envelope, the support on that balanced area, on that trading range is about 45.66, and until that's broken, you really can't use that as a selling point, in my opinion, except for a resistance area coming back up into that area. So right now, short-term traders have a lot of opportunities on this. Looks like we're going to be a little range bound on it. And the scanner also gives those inflection points to pay attention to. Guys, we're going to be right back, and we'll have Steve Banger with us.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the Tom O'Brien Show. I'm John Logan, filling in today for Tom. He's in sunny Costa Rica. I'm jealous. We might go down there and rescue him because I heard he's having a bad time. I'm just kidding. Guys, I think we are honored now to have Steve Banger with us. Steve, are you there?
I am, John. I am. The honor is all mine.
Oh, man. Good to hear your voice again.
I know.
Folks, Steve is, I would call him a market wizard. He's in Chicago. He's a big guy in the Board of Trade, and has actually run a pretty big clearing operation. And I love to talk to Steve about the markets because you get a very good macro view every time I talk to him. And I love to bounce things off of you to see if they're valid or not, Steve.
Sure. But before we even start, John, and I hate to correct you because you're usually dead on, right? But my exchange days are long over. You realize that, right? Because we've known each other for 20 years. You should know that.
Well, you're still in the loop down there in Chicago, and I would consider that still being involved, if you will.
All right. That's okay.
I tell you what, what's on your mind? Because we were talking about something pretty interesting earlier, and this Brexit thing is not over with, and all the kind of fallout from it. And we were talking about also how this relates to some of the yield plays going on, and I'd love to hear some thoughts on that for everybody to listen again.
Yeah, I mean, obviously Brexit was kind of like an earthquake which didn't last very long, and the markets seem to have recovered very well on the equity side of the market, that is. But what has become pretty apparent is there's a huge discrepancy as to how the debt market handles the whole situation and how the equity markets handle the whole situation. And once people start looking at that, it's actually rather astonishing what's happening and how those two markets are really detaching itself from each other. They're usually in lockstep, but right now there's a huge non-correlation going on.
Yeah. I was talking earlier about the 10-year, and a decade ago, I remember, Jimmy Rogers, and there's so many people that, oh God, this is going to end terribly, and the bonds and notes are already too high. And this thing has just continued to march north forever, it seems like. And even up here, I've kind of submitted to it, and it relates to some of the things you just said to some degree. But it's just okay. It's not backing off. The market kind of gives you these indications that it's okay to continue to buy it every once in a while. And I mean, in previous years, I'd be like, "What am I doing? This thing's already kind of blown a gasket." But do you think it can? Do you think these notes and bonds, I guess, can go higher? Is my question.
Well, and that's really the $1 million question, right? I mean, where are they going?
Right.
So I think in order to answer that, it really pays to kind of look at what is happening in the world. I mean, Japan, as being the second largest economy in the world, or third largest, but really the second largest in terms of capital markets which are accessible, has negative interest rates throughout. So any non-US investor, any non-domestic, from a Japanese perspective, investor is really not going to put money into Japanese bonds anymore. Not that they ever have in the first place, but that's a different story altogether.
Right.
The German bond market is now solidly negative too, which is the third or fourth largest economy in the world. So money flows to where there is yield. And right now, among the well-developed capital markets, clearly the US market is the only one which still offers some yield in its government papers. And that, I think, is the reason why we are seeing continued influx into the treasury market, which really suppresses our interest rates. But what really needs to be understood and be talked about for your viewers, I think, is that the entire yield curve we have is compressing. Like earlier this year, the yield curve, or the spread of the 10-year Treasury over the 3 months bills, was about 210, 214 basis points. We are now down to about 110, 114 basis points. It really depends on the day. So without really anything happening in the stock market, because the market by and large has pretty much gone sideways,
Right.
the yield curve has compressed for that period by 100 basis points, which is huge. So the question is, why does the yield curve change so much without really anything big happening in the stock market? And that really leads us to the theory that potentially the debt markets are pricing in a recession. And if that were to be the case, then we will be looking at a major revaluation in US stocks. And that is a big disconnect we're having right now.
Right. Okay. So, but how much of that yield curve flattening in the U.S. is maybe not possibly not exactly, indexed to what you just said as far as, predicting, possible reevaluation, all that, and just basically being kind of arbed into, a lot of the other. I mean, I know you talked about Japan and a couple other places, but how much do you think it coincides with a global kind of recession, or is, what is the connection between the U.S. rates and some of the things going on overseas, as far as like being able to kind of this yield to continue to go down, that may not be completely indexed towards the U.S. economy, if you know what I mean.
Yeah, I think I do.
Okay, I didn't explain that at all very well, but I think you get what I'm saying.
Well, I mean, let me rephrase what I think you are trying to say, if that's okay with you.
I'm good at confusing people. Go ahead.
Not me, though. So I think that there's a significant reason related to the inverted yield curve or negative yields in Japan and in Germany, which drives money into the US debt market. So a good portion of why we are that low in the yields is attributable towards those two markets and a general decline in interest rates across the world. But one has to look as to why that is happening in the first place. The reason why Japan is negative is because there is no economic growth, right? I mean, that economy doesn't grow, regardless of what they're trying to do.
And it probably won't.
Yes.
No matter what.
Yeah. So German bonds are negative because there's a safe bet within Europe, and Europe doesn't really grow either. So we have recessionary tendencies fairly well established in Europe. On top of that, we now have a Brexit, which will, at least if you believe the analysts, will almost certainly prompt a recession in the United Kingdom. So the likelihood of recession or non-existing economic growth is what is driving or force-feeding money into the bond markets.
Steve, I hear the music. Can you stay on for one more segment, or at least part of it? Do you have time?
Yeah.
Great. I'd love to continue this. Awesome. Guys, come back to see us. We'll be right back.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Today, many commodities are trading at relative lows. And now you can take advantage with Everbank's new limited-time, 5-year, market-safe currency comeback CD. This indexed and U.S. dollar-denominated CD offers 100% principal protection and is based on the equally rated performance of currencies of Australia, Canada, Chile, Mexico, and South Africa. These 5 countries are especially rich in commodities, and their respective currencies are poised to do well should commodity prices begin to recover. Keep in mind that no APY, or periodic rate of interest, is paid on the CD. Don't miss out on this innovative new financial opportunity. CDs must be opened and funded by the upcoming July 14th deadline. To apply online and learn more about the CD, including product terms and disclosures, visit everbank.com/TFNN now. This advertisement is sponsored content. Everbank is a member FDIC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the Tom O'Brien Show. I'm John Logan, filling in today. And we're continuing a discussion with Steve Banger, a friend of mine out of Chicago, down in the loop there. Steve? Can you continue, sir?
Yes, I'm still here. All
Great.
right.
Because when you talk, it's much better than when I talk. So let's keep you talking.
No, well, I mean, everything I said earlier is actually supposed to lead to that one point which I would like to make. So the yield curve, no matter what the reason is, has flattened to a point which the last time we've seen that level was in August 2008. And we all know what happened subsequent or right around August 2008 and throughout the remainder of 2008. We had very material losses in the stock market and huge gyrations. So
I barely remember that, but go ahead.
yeah, we all do, right? I mean, because we all would like to forget.
It's burned in my brain, but go ahead.
Yeah, we would like to forget that whole thing.
Exactly. Yeah.
Right. But the point to that whole thing is that we have created a scenario, no matter why, which is eerily similar to 2008, at least on the debt market. And in the same context, the stock market is bumping up against all-time highs, at least in the United States. So if we truly hit a recession, there's a long way to go down. I mean, I call that scenario or that setup a widowmaker.
Gotcha. You still there?
I am.
Okay. Yeah. Well, and again, you know, the thing we were talking about before, I wanted to see if you could answer the question that I was kind of stumbling through, trying to ask before, which was, you know, if all these things weren't going on in the world, all things considered, if there wasn't that arb trade going on with the other kind of rate structures, do you have any idea where? What do you think rates would be in this country based on, you know, the cooked books of all our economic figures, blah, blah, blah?
I think rates would be about 1% higher, give or take it.
I think that's probably a fair assessment.
Yeah, I think that the Fed fund rate would have to be around 100 basis points, 125 basis points, somewhere in there. But that doesn't explain why long-term interest rates are basically closing in on 1%. Right, that's a rate which really indicates and flashes recession probability.
I agree. Listen, I'm showing the British pound right now, Steve, and you know, we're down to 130 approximately right now. This is a 30-year low on a relative scale. Mm-hmm. Is that what the latest benchmark kind of statement is out there, as far as, you know, where this thing has come down to? Yeah. Do you think this thing? I mean, where's this one headed? I'm sorry to put you on the spot.
Well, yeah, I don't think it's heading up. I mean, that's I don't think it's heading up. So right. Obviously, a lot of the decline has been made, but I don't see a reason why it couldn't work itself down to like 125 or so. But it's not heading up, that's for sure. As I mentioned earlier in your show, there's no consensus among the analyst community that the UK will hit a recession within the next 3 months. And given that scenario, that currency is going to crater. I mean, it has already cratered, but it's not going to go up.
When is the? Do you know when the projected, like, they get control of kind of, you know, more? I mean, are they going to try to speed up this 2-year process that, you know, this kind of transitional period, or aren't they already lobbying for that to kind of go ahead and, you know, get it over with as soon as possible? And then that would also possibly cause the pound even more problems, because then they'd have kind of full control to, you know, do what they, you know, I'm not going to say they're going to pull a China, but, you know, really kind of so-called fix things.
Well, I mean, typically speaking, political events move at a glacial speed, right? I mean, nothing ever happens within weeks in that industry. So the next prime minister of the Conservatives is not even going to be elected, the way I understand it now, before September at the earliest. So we have a good 2 months before the next government is even in a position to make decisions. So I would be shocked if they get the Article 50 filing done before the end of next year. So I think we have at least another 12 months, potentially more, of wait and see. And that whole wait and see situation is not going to be good for the British economy.
I hear you. Let me ask you another one that I follow this one kind of religiously now. The euro. Is this thing apt to just come apart at the seams also? I mean, the next, you know, the Italian kind of talk is going on. I mean, there's all kinds of rumbling. How, you know, what's the forecast in your opinion on this one?
You know, it's actually very interesting.
It's holding up relatively well in all this stuff. But go ahead.
Yes, it is. It is. So the weekend after Britain voted for its exit, there was an election in Spain, which turned out to be much more favorable towards the parties more closely aligned to the European Union than it was originally expected. And some more recent opinion polls seem to indicate that some of those countries which were notoriously known for being anti-EU are coming around a little bit because they really don't like the consequences which Britain seems to be suffering. So the reason why the euro is or has remained fairly strong is really because of that. I mean, in the beginning, everybody was afraid that British accent is going to make a break of the European Union much more likely. But now there's a belief, at least in some areas, that a British accent will teach everybody else a lesson and it's going to make the Union a little bit more stable. And that is what you see in the currency markets right now.
Well, I am looking at you can look at this a lot of different ways, and that's a great viewpoint on it, in my opinion. But man, I mean, you could look at this as, wow, it's in the face of all this. There's kind of, not a bad little bit in it, and usually, those types of things usually like, wow, everybody's thinking the same thing I'm thinking, and all of a sudden they just kind of run it up in you on the north side,
Yes, I mean, it certainly is not the demise some people were hoping for, if you look at it this way, right? It's not completely falling apart. You have this huge downward move one day, and then it bounced back. It's been working itself back up.
Right.
So it really has been a one-day affair for the euro currency unit, whereas for the British pound, it's vastly different if you compare the charts.
Without question. Now, this one kind of weirds me out too. The yen trade, the U.S. dollar yen trade. I'm showing this right now. 101. That general neighborhood's a big area for support on this thing in my book. But do you think this thing gets below par against the dollar? And for God knows what reason. What's your thoughts on this one?
Well, I mean,
we got a little music coming in. We got to take a break. Can you stay on at least to answer that question, and then I'll let you go.
Is that perfect. Yes.
Okay, cool.
Yes,
right.
Sounds good.
We're coming right back, guys.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the tfnn.com homepage or call our office directly at 877-518-9190. There's a limited supply, so act now. Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Tom O'Brien.
Hi, guys. Welcome back to the Tom O'Brien Show. I'm John Logan, filling in for Tom today. We've got Steve Banger we're talking to about quite a few topics. I'm just running you through the mill here, Steve.
That's all right.
The last big question, and I won't keep you much longer because I know you got to run, but the Japanese yen, where's this thing headed? Because I thought, around 101 or so we were going to bottom out here, but it looks like it doesn't really want to stay away from that area, and we may head lower. What's your thoughts on this one?
Well, I mean, just for comparison's sake, why don't you put up a chart for the 10-year Treasury? And I think that pretty much might give you the answer. If you follow the theory that a flight to quality and safety is pushing up U.S. Treasury yield prices, then you pretty much have the same situation in the yen. A flight for quality, a flight into safety, perceived safety, is what pushes up the yen.
Yeah, I'm just wondering how safe the Japanese.
Well,
yeah, it doesn't make a lot of sense, but it doesn't have to, I guess. But go ahead.
I know, right? But honestly, you really have to look at it on a relative basis. The devil you know is better than the devil you don't know, right?
I hear you.
You can't put every egg you have in one basket. So when you sit in Europe, where are you going to put your money? You can put into the US dollar, but it's not that we look like rock stars either all the time.
How about gold?
Well, some of that money is going into gold. There's no question about it. Talk about silver. I don't know if you have looked at silver.
Oh my God, yeah. I actually thought my chart was wrong when I woke up this morning. I was looking at it on the show this morning, and I said, well, that can't be a real print at 21. What happened?
Well, I think it's basically a bubble, right? Bubble in terms of people trying to find things to invest in. And the problem is that not many well-developed capital markets who can absorb comfortably a large amount of money. So when people try to reach for silver, which really is a small market, that whole thing blew up big time. Look at that move.
Incredible.
Right.
Incredible. Well, you know what all this is, doing to the housing market in the U.S. right now. I sold a house I had in Raleigh, North Carolina, back 2010 maybe, and just a regular house, nothing crazy special. It's doubled. That the value of it is now doubled, and the real estate situation in the U.S. These rates, just force people to go out and they're not getting super crazy with the loans again, but they've got some innovative new strategies out there. I was kind of looking at the investment rental type mousetraps that they have out there now to don't check your background, just put I think it's 15% down, and you're in business if you've declared it a rental property. What do you think's going on with that market now?
Well, if you really look at what's going on in the world, everything within the context we talked about during the show, where are you going to put your money? Where are you going to put your money? And real estate all of a sudden at a solid 4, 5, 6% looks pretty damn good.
Well, how does that not cause... where does the inflation pop up? It's somewhat popping up in that market, but then you've got rates continuing to go lower. When does the rubber band get stretched out so far that or does it? I mean, do the risks just? I mean, do the people who have money to kind of the powder dry to continue to do the? I mean, how does this? Where does this end? I'm getting fatalistic here.
No, I mean, you're absolutely right. I mean, ultimately, we have set a cycle in motion, which can only be stopped by a catastrophic event at this point, right? Because we have this easy money coming to the system all the time. Money is so easily available, and there's a scarcity of decent assets to invest in. So the assets which are investable tend to get invested more and more, and people are prepared to accept less and less yield. So the only thing which might potentially change it is an external event. That's how I look at it. I
think you're right. Well, look, thanks for coming on today. It's been everyone's pleasure, I hope.
It was my honor, John, as always.
Yeah, thanks again, and we will pick it up later, I'm sure.
All right, great. Thank you, John.
Thanks very much. Guys, I was looking at the silver chart this morning. I thought we had a bad print on the East signal. That is an amazing move in a relatively small market. Sorry about that, folks. We're going to take a look at the S&Ps here. One of the things that I always look for moving right into the S&Ps is when we get into these major long-term inflection points. We had one at 2033 on our weekly, and then we had another major inflection point on our weekly on the S&Ps. These are the September futures, S&P futures, 2101, that unfair high, and that coupled with our daily around 2105, 2106, that was pretty much hit this morning, or in the overnight trading, or early this morning, put it that way. We backed off, so we're back in the kind of the so-called balanced area, not terribly deep, with let's see, how much have we pulled back here? 25, 30 points off of that DMZ. Again, we've accomplished a lot moving back up with this Brexit situation, but now I think, just like always, we're waiting for some new news. And coming into these inflection points most of the time provides trading opportunities. I wasn't a huge fan of being long this thing on the way up because, I was like, okay, we had the sell-off. Looks like we might kind of rally up into some higher inflection points, higher resistance areas, former support now resistance. But and I actually got stopped out twice coming on the rally up. But this morning, finally had some resting orders up there that actually kind of caught some legs here on the way down. Where does this thing end? I think we're in store for a little bit more of a downside move. I think 2064 is easily in order here on the S&Ps if you're trading the S&Ps. How do you play defense on that type of trade? I'm showing our 240s. We kind of get down below. We break stride here. This is a great regulator of the trade if you're doing technical trading, in my opinion. So we kind of got below there. We traced back up, and now we're kind of hovering below. So what I'd like to see is another profile appear here on our short-term 240-minute view and then kind of skate down into 2064. Then take a look and see where the internals are, looking at our kind of aggregate net profile calculations, and just see if we still have a strong, coincidental net profile breadth positive situation. And if we do, I think you got to be buying that 2064. This is something that I follow pretty intensely to see if the internals are still looking relatively strong, and we've got kind of a monitoring system we can pay attention to there. So 64, again, kind of waiting and seeing on that one, trying to stay short until we get down into that area. Let's take a look at gold. This is one, we had a pretty decent move up. The silver, and gold kind of, like Steve was talking about, where do you even put money? So we get above there and we go back and retest this 1340, and we're kind of hovering above profiles now on our daily and looking like we want to pierce recent highs here from the Brexit situation. So I'm looking for that to happen. We're going to be right back, guys. We're going to have Andy Hecht on this hour, so stay tuned.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, guys. Welcome back to the Tom O'Brien Show. Last segment here on this hour. And the next hour, we're going to have Andy Heck, so please stay tuned. Just a wealth of knowledge. I love listening to Andy. I think we have a caller. John from Philadelphia. Are you on with us?
John Logan, good afternoon to you.
Hey, man. Good to hear your voice again. I'm good. Thanks for asking. How are you?
I love how you're doing double duty, filling in on the TFNN network. This is just terrific.
Oh, well, thanks. Thanks for saying that. What's on your mind?
I wanted to ask if you'd give us your parameters for September Chicago wheats. Made new lows this morning, and I've been out of the den past couple hours, and I noticed a couple of well-respected denners, by the way, Tiger's Den, a terrific deal, noted that a bottom occurred right at a price level of interest and that we've got a reversal, at least on the 5-minute chart here today. So can you share with us when you start bottom picking this thing?
Sure. I've actually played golf over the weekend with some grain guys, and we were talking about that bean action that you and I were talking about last week, and then corn, and just around here it's just been insane good weather for a lot of grains. But on the wheat front, there's not a lot of wheat growing around here, and I was kind of pitching them on, how does this wheat trade end up? Because we're getting to the point, we're getting pretty low here. But the way I look at it is this. I mean, I'm showing a chart right now, and I'm showing the 240-minute kind of profiles, and they just kind of help me, on the more intermediate trades, knowing it's kind of time to get back in the water, or when the green shoots might start appearing. I'm not a good bottom picker in general. So what I look at here, John, is I see a new profile attempting to appear on the 240. I'd like to see that happen. 432 looks like where this product closed, or is last price right now. I'd like to see this new profile appear, and I'd like to see the price get back above a 240 profile for once, since back on I guess the 8th of June.
John, I just have to share this.
Sure.
For anybody who's listening that doesn't buy your service, they have to come into the Tiger's Den, because I'm looking at your September Chicago wheat contract with the 240s, and this thing has never once turned positive since that peak back in June.
I know.
That's just a beautiful thing to keep you out of harm's way.
And I was going to say, it keeps me out of trouble. It keeps me from trying to, we had a little bit of a break in profiles, but it was very short-lived last week, I guess. But again, it kind of lets you know, okay, well, that didn't work out. The long-term trend is still enforced down. And that, that really, kind of, it blocks out one side of the market for me, John. And, if I can kind of say it's okay to be long, and not okay to be short, or okay to be short and not okay to be long, that really helps me out. And on the long-term situation, I'm showing the daily now, it just doesn't, there's no new real serious bottom action that I see on the daily happening yet. And the 240, we don't know where that profile is going to be. So, this could just be another rally up into resistance that is meant to be sold. I don't see anything really serious happening yet.
Okay, so, appreciate you sharing that. On that 240, the most recent 4-hour bar was displayed in yellow. That gives us a warning or a clue that a new profile is about to return?
Yeah, warning, a new balance there is possibly coming up. And I'll keep my eye on this one. John, thanks for calling in. We're going to end the first hour. And thanks for... Guys, we will be back next hour, and we're going to have Andy Heck, so stay tuned.
The following is a presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-445-1044.
Let's go to Dell in Texas. Hey, Dell, what's going on?
Hey, Tom.
How you doing, man?
My call. Great.
Thanks for calling. Thanks for holding. Appreciate it.
I love your show. I just stumbled upon it probably, maybe a month ago.
And how'd you find us?
I found you on YouTube.
YouTube. That's a beautiful thing. Well, we appreciate you growling and prowling with us. Welcome to the Tiger family, man.
Wow.
I like it. Totally.
Now, Tom O'Brien.
Hi, guys. Welcome back to the second hour of the Tom O'Brien Show. And it's good to be here. I'm John Logan. I do a show every morning on the TFNN network from 8 to 9, the Global Market Pulse. And you guys are always welcome to drop by. Cover quite a bit in the morning. Try to get you ready before the markets open, the stock market, that is. And it's always good to have guests on my show. And we're honored today to have Andy Hecht on in I guess, start of the next segment. Looking forward to that. I learned a ton every time I listen to Andy's show. And I'm going to be looking forward to some of the fundamental comments and technical comments that he's got about, the usual suspects of the commodity world. And we're going to get into that a little bit later. We're taking a look at Apple right now for folks who are in the car. And if you could see the screen, I'm showing Apple right now on a daily chart. And what the premise is here, going back to our weekly for a second and looking at the long-term view, Apple, the spine was broken on this stock back in July of 2015. And what do I mean by that? That means that the market had made some new kind of moves up, and Apple was kind of languishing here within long-term profiles, our long-term balanced areas. Then we started finally trading below balanced areas for the first time in God knows when, really, back in that time frame, July 2015. So that was about a year ago. Now we've been in a protracted downtrend as the market's kind of ramped up and compressed up into these, trying to get up through these all-time highs again. Apple has continued to make lower highs and actually lower lows. And what's going on right now is, even though we're within a balanced area here on our long-term view, if I go into our scanner and I look at Apple, what I see there is I'm showing bottom of our daily profile. I'm seeing a red there, and I'm seeing a 1. And that means that we're just starting to get past the precipice again of the next time frame across, which we always use to kind of regulate the trade in the way of the trend itself that's currently in force. That being said, the new pressure point here is, as the market's kind of dragged this up after Brexit, is 95.12. And that's what I'm looking at now as a chance to, let me get this out of the way here, as a chance to look at this as, okay, we've made another leg down, we're rallying back up, the market's dragged it up, and Apple, in my opinion, is not on sale down here. It's continuing to do the new lows, not wanting to break out on the upside, rallying back up into areas of resistance that we can pay attention to and actually, more importantly, play defense against. So as we look at this, you could look at this as, well, wow, Apple's made higher lows here on the intermediate, on the daily. But when you kind of step back and really look at what's going on and put that relative strength concept into it, that the market, may have just kind of rising tides lifts all boats lately for Apple. It's not a lot of interest in the stock. So when we start seeing a full-blown breakout getting above it, either intermediate or long-term profiles, it might be okay to get back in the water for this thing. But right now, all things considered, it's an ugly situation still. So fundamentally, I don't know all the ins and outs on the fundamentals of Apple right now, but technically speaking, looking at who's raising their hand right now, not wanting to be bought in a big way, it's Apple. So we're going to take a look at another one that's really been bouncing around a lot lately. Tesla. It seems to be just completely news-driven. Actually had a break in stride here. Here's our long-term view on Tesla. That was a big number, 233, after we broke down and went back and retraced back up into that area. And now, Tesla obviously is broken above these daily profiles. 202 now is going to be support on this, but you got a massive lid on this at 233. So, we're kind of smack dab in the middle of that. We're trading about 213 right now. What do you do with Tesla? Do you go in and buy it? I don't really look at buying something until we're, at least hovering or coming down into support, or conversely rallying up into resistance if we're in a defined trend. And right now, what's the defined trend of Tesla? You look back in time, and we basically have been just kind of bouncing around between 300 and 150 for a long time. And right now, you've kind of got a mixed bag as far as our long-term view and our intermediate view. So, again, I think you've got a range-bound situation from around 200 up into 233, and I think you've got to be buying at 200 and selling at 233 on Tesla. All right, so let's take a look at I'm sorry, I topped in the wrong stock there. Let's take a look at Amazon. We're going to hit Facebook really quick, too. Seems like these are in everybody's portfolio here. Now, Amazon, the Brexit situation kind of dragged this into, and we've got a scanner that really helps identify these areas. 678, got into that neighborhood. Now we're compressing back up into 731.50. I think we closed today at 729. So this is a stock you really are playing with fire trying to short this, because every time the market pulls back, it kind of tells you, all right, well, we've got a support area we can pay attention to. We're still in a defined uptrend. Very, very different from the Apple situation. And you have a relatively strong stock that doesn't want to get away from, even on a day like today, we're positive today, doesn't even want to get away from these all-time highs, which are also coupled with our weekly unfair highs, which means that is that resistance in the short term? Possibly, but any breakouts above there, you got to be looking at, again, using that to play defense as you were able to buy these 678 areas, because you're buying a strong stock in a market that's kind of dragging it down into support areas. So again, this is nothing to look at that's too high, just like you can't look at Apple, it's too low. Things in their lows go lower, things in their highs go higher. And when you have some market relevance factored in, you can play those things against each other and try to find opportunities, and that's what the scanner does for me. So Facebook, again, the weekly, we kind of rallied up, closed above these unfair highs last week around 113.64. Now we're kind of spinning around there. Market could drag this thing down, but again, when you're playing a relative strength, relative weakness game, you want to play defense with the stocks in this case that are going to be as least painful if the market just doesn't just a massive pullback. You want to be long stocks that are not going to pull back that much, and short stocks that are already showing their hand. So Facebook, not a situation I'd like to be short, no matter what. We're going to take a look at another stock and go to break in just a second here. And when we come back, we're going to take a stroll down commodities lane with Andy Heck. We'll be right back, guys.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Are China A shares hot or not? If you trade China A shares, now may be time to take a closer look. Trade CHAU or CHAD, Directions Daily CSI 300 China A Share Bull and Bear ETFs. China A shares in either direction. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Tom Swim takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the Tom O'Brien Show. I'm John Logan filling in today, and we are honored. Andy Hecht, are you there?
Hey, how are you?
Good, man. Good to hear your voice. How are you?
Good to hear yours. I'm doing great. Where are you today? Are you here in the U.S.?
Yeah, in the U.S. and North Carolina right now. I've kind of stayed around for a while. And
oh, excellent. Can you see Hillary and Obama from where you are?
I've got my binoculars out, but they're not strong enough to see all the way to Raleigh right now. But yes, I hear they're in town.
They are in town. And the election circus is going, and the markets are going to reflect that now, in my opinion.
I guess she should be celebrating. You heard about that, right?
Oh, yeah. Well, it was kind of a mixed blessing. I mean, I heard Comey speak this morning, and it kind of sounded like he was leading up to saying something negative, but it turned out well for her. Very interesting, very interesting. But, look, we got an election coming up with two of the most unpopular people in the history of this country running for office. One of them is going to be the president. It's insane. It's insane. And the markets, markets reflect this stuff. It's so uncanny. Let's start by talking about precious metals if we can.
Please.
And let's talk about what's going on here. You had silver up to $21 and almost 25 cents over the last 2 days.
Andy, I thought I had a bad tick on my chart this morning when I woke up. I was like, what the 21? Are you kidding me?
That was in Europe. Yeah. I mean, it just took off yesterday. And you know what? The volume today is pretty good. And hey, it makes sense that it's coming back to this 20. I think it's really healthy that it came down and tested this rather than kept on going. Silver's been acting great. It's been, but what's going on, in my opinion, here, John, is very simple. You had gold, basically go up out of the gate today, and the gold rally's been nice and slow and steady, and silver lagged, platinum still lagging, but silver is now validating what gold has been saying all year, and what gold's saying is it's telling us, hey, we're trained to look at currencies against each other. We're trained to look at the dollar versus the euro, the dollar versus the A dollar, the dollar versus the yen, the euro versus the yen. The bottom line is all these currencies are falling in value because faith in governments, faith in central banks and political institutions are going down. I mean, we saw it with the Brexit vote. We'll probably see it here in this U.S. election. I mean, it's going to be very contentious, well, whoever comes out on top. But gold has done very well because gold is a hard asset. It's hard money. I'm not a big believer in Bitcoin, but Bitcoin's moved from 250 to like 680. So people are looking for other forms of currency.
What do you? So if you're not a big fan of Bitcoin, and I'm not either, by the way, do you think? I mean, we were talking in the first hour about, where can you safely pile money into? We're talking about a real estate bubble. We're talking about the 10-year. Wouldn't gold really almost be on sale, all things considered, right now, still around 13 and some change?
Yeah, well, look, it got up to 1920 in 2011, and it got up to like 875 in 1980. In kind of, if you adjust for inflation, that high was much higher, probably higher than the 1920. But at the end of the day, I think these precious metals are telling us something important. I wouldn't plow money into gold. I'd be plowing money into platinum because it's so cheap. To me, the risk reward on platinum right here with gold right here, it doesn't have to move $1 higher, is $100 down on platinum, 400 up. Because platinum is, even rarer than gold. I think people are going to turn on. Listen, for a long time, John, they didn't turn on to silver. In March, the silver-gold ratio went to 83-1. Silver was depressed relative to gold. We're seeing the same thing in platinum now. We're going to look back in a couple of months and say, wow, platinum was on sale. We should have bought it at around $1,000 an ounce. I think you're going to see the same thing happen.
Is there any way that you can think of to safely play that? I mean, I don't even know if I want to say intermarket spread on that, but is there any way to kind of look at that and play that thing safely as far as, maybe doing an option kind of
Well,
hedging type?
there's no platinum options because it is such a thin and illiquid market. But what I would say is that, there's a lot of people out there who hold gold, who buy physical gold. And I'm a big fan here of selling a third of whatever gold holdings you have and buying and replacing it with platinum. And hey, the market's going to pay you $280 to do so. Now, platinum has very big premiums on it because, there's not a lot around. But what you can do is you can buy a contract of platinum on the New York Mercantile Exchange, and you can actually stand for delivery and take delivery of the bar at no premium.
That's a good thought because, I mean, what's the the bid offer on something like that? Is it even? I mean, do you have to just kind of be a long-term guy? There's no way to. To be honest with you, I got to admit to you, I don't look at platinum that often. I haven't looked at it lately. What's the liquidity on something like that?
The liquidity is okay. Let's take a look at platinum today. Let's see how many contracts traded. I'll just get it up on my CQG here. We had,
my favorite platform, by the way.
It is good. We had almost 25,000 contracts trade today, so it's not bad. I mean, it's it's not frozen concentrated orange juice, it's not cotton, but it's certainly not gold or oil. You gotta pick and choose your spots here. Probably the bid offer spread is about $1 for a contract, and we're not talking about going in there and buying 10,000 contracts. Those days are long over for me when I was at Solomon. But you can execute effectively there. You can also go to Everbank, and they have very attractive ways to buy platinum, certainly. But if you want to avoid the premium in total, I think the Merc is the cheapest game in town right now. They have to, if you stand for delivery, they have to give you a warehouse receipt that represents 50 ounces of platinum. And, there's probably some delivery charges, but it's not these crazy premiums that the normal coin dealers that you see on all the corners are going to charge you. So,
while we're on metals, can I stay on the metal scene and ask you about copper because
absolutely, great thing to bring up here.
Where's the edge on this one?
You know what? I'll tell you, copper is so disappointing, and copper looks like it's putting in a bearish key reversal today. If I look at the base metals, let me just go through my notes for the show because I wrote this up for my show, but I want to share it with you. Aluminum was up 9.5% in the second quarter. It's up 8.6% for the year, right? Okay. Nickel was up over 13%. In the second quarter, it's up like over almost 9% for the year. Everything I could go on. Lead was up. Zinc is up huge. Zinc is up like 30%. Even tin is up. Copper is up like 3% for the year. It's the laggard. The problem with copper is that the Chinese bulked up in terms of inventory over the last couple of years, and it's on these financing deals. And there's so much copper in China now that it's kind of like a roadblock standing in front of it. The stockpiles have to decrease for copper to really catch a bid here. And copper's been a laggard.
Is it worth looking at this as we may get some kind of impending breakout one way or the other and do some kind of, long strangle and just kind of wait it out?
I'm actually kind of neutral on copper. Copper's got to get above 233 to break to the upside. It's got to get below $2 to break to the downside. It doesn't want to do either. It's one of those things to leave on the sideline. There's so much else to trade today.
Andy, can you hang around with us?
Absolutely.
Please. Awesome. Sure. Guys, we'll be right back.
Today, many commodities are trading at relative lows. And now you can take advantage with Everbank's new limited time, 5-year, market safe currency comeback CD. This indexed and US dollar denominated CD offers 100% principal protection and is based on the equally rated performance of currencies of Australia, Canada, Chile, Mexico, and South Africa. These 5 countries are especially rich in commodities, and their respective currencies are poised to do well should commodity prices begin to recover. Keep in mind that no APY, or periodic rate of interest, is paid on the CD. Don't miss out on this innovative new financial opportunity. CDs must be opened and funded by the upcoming July 14th deadline. To apply online and learn more about the CD, including product terms and disclosures, visit everbank.com/TFNN now. This advertisement is sponsored content. Everbank is a member FDIC.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
It's 2016 and TFNN has a brand new programming lineup to kick things off. Starting January 4th, Swim Lessons by Thinkorswim and TD Ameritrade will be airing 5 days a week at noon Eastern Time. Join hosts Scott Connor, Kevin Hinks, and Cindy Faber as they host their daily options program live at noon 5 days a week with no commercials for the entire hour. Nico DeHaan and Paige Clark will be moving their program, Living a Primal Lifestyle, to twice a week, Tuesdays and Thursdays from 7 a.m. until 8 a.m. Eastern Time. Wake up with Nico and Paige and start your day off right. The Bull Bear Binary Option Hour by Nadex will now be live Mondays and Fridays at 10 a.m. Start and end the week with the three hosts, Tom O'Brien, Tommy O'Brien, and Daryl Martin, as they break down the world of trading binary options and spreads. For all the details on the new 2016 programming lineup, visit the front page of TFNN.com. TFNN, educating investors.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the Tom O'Brien Show. I'm John Logan filling in for Tom today, and we've got Andy Hecht with us. I hope for 2 more segments, but we'll see if...
Absolutely. Absolutely.
Great.
So,
Andy,
hey, I wanted to mention, I have, for anyone who wants to really see, in detail what I'm thinking about all these commodity sectors and stuff, I killed myself at the end of last week. I have like 9 or 10 articles out on Seeking Alpha. I did a quarterly report for each of the major sectors. I also wrote up an article called The Top 10 Reasons That the Stock Market's going to Tank in the second half of the year. So there's a lot of interesting stuff out there on Seeking Alpha that was published this morning.
Great. I'm gonna look for those after the show. Man, you did the series you did on the most recent series that you did on the commodities in general.
Oh yeah, the lessons.
Man,
yeah, the 12 essential lessons.
Incredible. Are those on archive?
They are. They're on archive, and anyone can still order them. That's stuff that I actually teach. I used the basis for those courses, John, on my I'm kind of a lecturer at the University of Colorado Denver Business School, and I go there twice a year and do a week here and a week in the fall, a week in the spring, and basically give a course to post MBA students who are working on their doctorates and on commodities, because it's not really covered that well, and a lot of the stuff there is the basis for stuff I teach people who are going to go into the business of buying oil refineries or copper mines or gold mines, and top that become top management. So I really I think it's a great course for everyone who's trading in these markets.
I do too. Once you jump into the futures markets, you really need to understand everything that's going on, and I know those courses are insane when it comes to a full understanding. So I recommend
I know it's good. Listen, I always look at it. It's like a jigsaw puzzle, There's so many different pieces. You look at the prices on the screen, and hey, they tell that they're only one part. They're an important part, but that's price. You got to understand value. And what I really try to do in the course is explain how to kind of get beneath the covers and understand what value is in terms of these things.
Great. So, talking about value, can we talk about the value of soybeans right now?
Absolutely. Let's talk about soybeans.
Can we talk about new crop?
Yeah. Absolutely. All new crop. All new crop.
Okay.
So let's put up the November beans chart, and today we're coming down. I mean, not a surprise. Not a surprise, because we've gone from $8.50 to $12. We had a situation in Brazil where there was a drought. We had Argentina. There are floods. These are big producing countries. In their seasons are opposite. So now it's all up to Mother Nature, and the next big day for soybeans is the 12th of July, which is 1 week from today. And 1 week from today, the USDA is going to put out their World Agricultural Supply and Demand Estimates report. And the last one was showing that inventories are not that good. And that's why soybeans zoomed. Now, they're coming down because some weather forecasts are decent for the growing regions. Corn and wheat have not followed because there's big supplies in corn and wheat. But the beans are still a problem. In terms of supplies, you have meal that traded up to like $400 a ton. All right, now it's at $380, but it was in the low 200s a couple of months ago. The oil is also bid, so you have the crush spread up at about 100, which is high. I think soybeans look good here. I'm a scale down buyer of soybeans, but I want to really not be too aggressive until right before the WASDE, and then I want to buy some call options going into the WASDE.
What's the limit down? Is it 60 cents? Is that the?
I think it's 75 cents in the beans.
Okay.
I think so. I'll have to check that. But it's 60 or 75, one of the two. But listen, hey, it's gravity, man. It's also you have a lot of specs in the soybeans over the last couple of weeks, and you have a new quarter. Let's also look at it from the speculators' point of view. They wanted to get the best possible mark and make the most money on their speculative positions at the end of June. And now, they're saying, hey, maybe there's somewhere better to go. Maybe we'll go to silver. Maybe we'll go to platinum. Maybe we'll go somewhere else. So let's pare this trade back a little bit, give ourselves some room. And I think that's what's happening. I think you're seeing speculative froth knocked off the market. If we look at open interest, John, on June 23rd, we had about 863,000 contracts open interest on soybeans. That's all contracts. Wow. Today we're down to 778. So that's a pretty big dive in open interest, and that is mostly speculators, because a farmer who sold soybean contracts and is going to use them, he's not unwinding that until he delivers his physical and then unwinds his basis spread. So this is all moves in the speculative position. Soybeans are certainly in play. The wheat is the really interesting one here.
Right. On soybeans, just to finish up, because we kind of are having just a complete reversal off of that report, almost back to where even lower than where we started. Do you think, we're just going to test some people's nerve, I guess, and just kind of trail off a little more? And
I think it's possible. Listen, you have huge volatility. We went from $8.50 basically to $12, right? I look at key support right here at about 10 1/4. That would be a 50% retracement roughly of the move that we saw. So that's kind of the line in the sand, I think, for beans. Could they extend through there? Could they put up a 990 print? Listen, they're grains. Anything is possible with these agricultural commodities. Yeah, take a look at sugar. It went from 10 cents to 20 cents since last August. These are, we're seeing very big moves here. But I think for the speculators, there are some other markets that kind of offer better risk reward now. So we might see them leave soybeans and go for something else. Maybe they're going a little bit into wheat because the downside is kind of limited in wheat, and the upside could be very interesting. Corn, the same thing. Coffee's looking good because that's bucking up against some important resistance. And cotton, to me, looks amazing. So there's a lot to talk about.
No kidding. Let's talk about coffee for a second, if that's okay with you.
Sure.
What month are we?
I'm looking at September.
Okay.
And we are kind of up, closed today at resistance. Every time we've gotten up to here to the $1.45 level, we have come off sharply. But this time we're kind of hanging in there. So, and open interest has come down. So we have to wait and see. I've seen a lot of things. Coffee demand is growing like crazy. They're selling these K-cups like there's no tomorrow in the United States. And there's more and more coffee shops popping up over all over Asia, and you probably see it where you are. You have Starbucks kind of invading everywhere now.
It literally
you know,
shocked me. Yeah, it shocked me when I saw Starbucks where I usually camp out over there. I was like, how in the world did this happen?
Oh, absolutely, absolutely. But that's, you know, that tells you something about demand. And demand never causes sharp spikes, but it does underpin markets. And when they sell off, you know, it's huge support.
Yeah, I'm looking at coffee right now. This is a nice little formation here that was.
Oh, I like it.
Yeah, developed
higher highs and higher lows.
Yeah, and it's kind of scaled above these profiles and that I look at, and we're kind of lurching again forward.
It's a vicious one for anyone who doesn't want to step into that futures market. Look at the JO. That's a safer way to play it. That's the ETN product.
We'll take a look at that when we come back. If you want to hang out, that'd be great.
Absolutely.
Okay, great. Thanks, guys. We'll be right back.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Tom O'Brien.
Welcome back to the Tom O'Brien Show. I'm John Logan filling in for Tom today, and we still have Andy Hecht with us. Thank goodness. Andy, you still there?
I'm here.
Great.
I am with you. I'm with you.
Hey, listen. Can we talk about corn, because in the close today it looked like wheat and corn kind of found a little bit of a bid, but where do you think where do you think this December corn's headed? I mean, because
at the end of the day, John, these things
perfect.
They are so close to production cost at these prices. The downside's limited, the upside's explosive, but you need an event. You need weather to intervene. You need gasoline prices to do better, because for a while ethanol was being very supportive for gasoline, but the oil market is kind of looking like it's falling apart. I've been saying for a while, we're talking about corn, but it's also interrelated, because I think that the oil price is showing some real weakness because products are weak, and products are making oil weaker, but they're also making corn weaker because the ethanol demand is not there. There's a lot of inventories. So corn, I don't see it running away on the upside. But one thing, all of these grains have picked up in volatility. So I think in all commodities you got to buy dips. You got to take your profits on rallies, because the rallies can turn into carnage very quickly. There's a couple of sectors that I really like. I mean, I love the precious here. I think they look great. I think soft commodities look pretty good because of the weather. One of the things I think is a real gem out there is Glencore. I think they're going to come back.
Let's talk about
big.
that. Yeah, let's talk about that. Go ahead.
If you could put a chart. Do you have a chart of Glencore stock?
Yeah, let me.
Yeah, if you could put that up there. This thing is around $2. This thing is run by some of the smartest people in the commodities world. They have been devastated, but what they've been doing is they've been paying off the huge debt load that they took on when they bought Estrada a couple of years ago at the highs of the market. No question, they bought the highs, but they are smart operators. They are selling off. They're keeping majority stakes, like in their agriculture business. I absolutely think that this company will do very well. I think this is a 100% gain plus on this Glencore stock if you're willing to buy it and hold it.
Yeah, I'm looking at Glencore PLC right now on the weekly. We're trading. I guess the final print today was around $4.
Right, that's the ADR.
Yeah, this. Can we talk about this one, or you want to talk about another one?
No, that's fine. We could talk about that.
This really looks attractive. I mean, for the first,
yes.
When we,
I love it.
I'm showing them on my chart here. Got above here, and then we're kind of basing on a new profile a little bit higher. And man, thanks for pointing this out, because I
like that one. You know what else I like? I like Rio Tinto. Rio is looking good. I think you're going to see these stocks start to react. Maybe not to the extent that the gold miners did, but as long as commodity price, these are very diversified commodity companies. They're gonna, this is gonna go to their bottom line. And the other beautiful thing for these major players is that they did what the Saudis did. They built market share during the bear market. So when the prices go up, they will make more money this time than they did in the past.
Man, God, this is. I hate to look at something that as if it's on sale, but I like this basin action in both of these stocks.
Right. I like Rio. BHP is a little bit more difficult here. They got a little bit more. I mean, Rio is cheap because they just changed managements, and good time to. I really like both of these. I actually bought them last week.
Wow.
Look. The whole, I have another article on that, and I think I called it, the markets are falling apart, but people need to eat. And the basic premise of the article is, hey, I think the stock market's going to fall apart. I really do. I think these valuations are way too high. You got the CAPE ratio at 26 times earnings. It's historically high. Currencies are in problem. You have Britain leaving the EU. You're going to have Italy probably leaving the EU. You have a crazy election here in the United States. You still have problems in China. Stocks are not going to do well, in my opinion. It's just, but commodities are going to do okay. And the biggest fear for the central banks who are causing a lot of these problems is stagnation and inflation. And I think you're starting to see the beginning of that. And that could be a real problem down the road. Prices rising and unemployment rising at the same time. That's a nightmare. What do they do then? Do they raise rates? Do they lower rates? Who knows?
I think you coined that perfectly. That is a nightmare.
It's a
goodness.
Nightmare for them. But I don't see. Do you see rates? I can't see any case for any central bank in the world raising rates now, given the British exit, given what's happening. With our election coming, I don't think the Fed can act with a U.S. presidential election coming up. The employment report Friday is going to be important. But remember what happened last month? I mean, it was a shocker.
Yeah, as cooked as those books are, yes, we do trade off for those reports, whatever.
Right. But you're right. The books are cooked because you don't have people who've dropped off the employment rolls. You don't have people who are underemployed in there. The real unemployment rate in the United States is probably, north of 15%. I mean, I've heard it as high as 25%. But if you include underemployed, it's huge.
No doubt. Can we hit crude before you?
Sure.
Before we got a break here, and then we got about 2 minutes left. Go ahead.
The big problem with crude for me is what's going on in oil products. You have lower production in the U.S. and that's bullish. You have problems in Nigeria and Venezuela. That's friendly to oil. The problem is gasoline. The problem is heating oil. The problem is jet fuel. Now, we don't often look at jet fuel, and I can't put it up on the screen. I'll put gasoline on the screen. I want to put a weekly chart so you can see how ugly this thing is. But the problem with jet fuel is that all this terrorism around the world right now, U.S. State Department put a travel warning on Europe. That means that less people are going to travel by plane, and that's less demand for jet fuel. Now I have a weekly chart here for gasoline. Crude oil's gone from $26, to almost $50, and it's still up there over $45 a barrel. But you have crack spreads in gasoline. They're $13 a barrel. Last year at this time, John, they were $25 a barrel. So that doesn't bode well for stocks like Valero. And we don't buy, as consumers, raw crude oil. We buy oil products, and if the inventories are too large, or we're not buying as much, or for whatever reason, it's got to translate back. So I think this weakness, we saw the highs for now in crude oil, unless there's some exogenous shock to the market. Here's the weekly chart of the crude oil crack spread. You can see it's $13. Last year in early July, we were $30 a barrel. I mean, we are almost a third of the price. It does not bode well for the price of crude oil.
My goodness, 30. Where are we at now? 12 on the crack spread.
We're at $13. It was at 27.66 was the low at the beginning of last July. And remember, we're in peak season for gasoline now.
You know what was wild that I used as an indicator in itself was when Goldman Sachs started. I think we were like trading 47 or 48 in crude, and they started going, okay, now it's time to buy crude oil. And,
of course.
It was.
That's the only thing that worries me about precious metals. They just raised their gold forecast, but they're so far behind the curve. I mean, it's ridiculous. They didn't. I changed on gold when the dollar started to kind of fall apart in terms of all currencies started to fall apart. Anyway,
Andy, thanks for
joining us.
Pleasure
to be with you.
Yeah, hey, it was awesome as usual talking to you.
Okay, talk to you soon.
Yep. Guys, we'll be right back for our last segment. Stay tuned.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the tfnn.com homepage, or call our office directly at 877-518-9190. There's a limited supply, so act now.
Join Andy Hecht as he shows you how to make money in commodities. The Commodities Hour, next on TFNN.
Hi, guys. Welcome back to the Tom O'Brien Show. I'm John Logan filling in. We're going to have our last segment here, and Andy Hecht was on with us early. If you guys missed that, you missed a real treat. He's the go-to person that I love to listen to when it comes to looking at short-term and macro commodity information. Just an incredible show he does. He's on next, actually, right after the Tom O'Brien Show today. So stay tuned for that also. He'll give you a complete angle. So a couple of my favorite trades on right now, we've talked about these for a while. This Euro trade, the reason I like this trade so much, you got to put the stops in on things like this, but, we're kind of starting to get back down below profiles on our weekly there. And I think the play for this, you could get, there's going to be some volatility here. There's going to be some new information coming out of Europe. So I think the way to play this, as my favorite trade, is short the euro, long in the money calls, and just try to, weather any gyrations on the upside and just be really buckled in when some new news comes out of Europe that could just completely crater this thing. Gold, I'm right in there with Andy on this one. Where do you put money these days? Where's the safety play? Where do you park it? And I think people are getting more and more attracted to gold as a place to park money right now. I mean, what's the value of currencies, as Andy was stating earlier? I mean, God knows, God only knows. I guess I should say that. Taking a look at a couple other currencies, I mean, the decades lows here on the British pound. And this is what I love about the profiles that we use every day on my show. You can play defense against some of these inflection points. Above 133, we talked about that, being able to play defense with a little bit of noise factor on the British pound. And there's no signs that this is going to, be on sale and it's time to pick up the pound again on some kind of bounce technique. There's no bottom in sight on this right now. And if you're in this on the short side, like we've been talking about, there's really no reason to take the trade-off. Going down the list here, considering, what oil's doing right now, I want to kind of hit a couple of currencies before we close the show. The Canadian dollar, and again, when you look at the Canadian dollar, you look at, rallies up in the Canadian dollar. We got to think about oil on this one. Coming right down to support, and the devaluation of the Canadian dollar could continue here north. I love the action on this particular chart. And I like how oil is just, coupled with some of the things that Andy was saying, I like how oil might just languish around here at best and possibly just kind of continue to fade a little bit. Remember, that country digs holes and sells what's in them. And the Canadian dollar, with the lower price on oil, could suffer a little bit here more, which means it could rally on the chart a little bit. We talked about silver a little bit. Still, that may be a buy support situation. Andy was really astute to point out the platinum possible opportunity there. And we looked at Glencore, BHP, looking at some of the technical basing actions on those particular stocks and, the risk reward possibly on Glencore. That was a really nice chart that we looked at earlier. I'm going to look at that one myself. One of the kind of default things that's going on with the FTSE right now, just to close the show on this, I'm going to bring up the Great Britain index, if you will. This is what's called a breakout here, and the devaluation of that currency. Remember, this index has got to reprice itself. The huge support on this right now, 63.10, down into 6,100. Any pullbacks on that? I don't even know if you're going to get a pullback right now, but this particular index and the component inside repricing themselves is going to continue to be a big deal, understanding that there's really no end in sight in the British pound on the downside. Guys, you've been great. Stay tuned for Andy. He's next, and I will pick it up tomorrow morning at 8 o'clock. Join us.